Thank you, dear audience, for joining us. We are delighted to have two exceptional speakers with us today. It is a great pleasure that we present Martin Naville, the former CEO of the Swiss American Chamber of Commerce, with whom I will discuss Trump 2.0. It's really quite interesting to see what he expects from the second term. Initially, however, my colleague in Dubai, Adrian Kirigin, the Chief Investment Officer of Probus Pleion Middle East, will take us on a journey around the globe. Before we start, I need to cover a few technical points. Please bear with me. Can I encourage you to use the chat function for your questions from the very start? This will help me and the team to structure, organize, and handle your questions in the most suitable way possible. Thank you. We discuss the global economy as well as geopolitics in a broad way today. We'll cover macro topics in some detail and share asset class preferences. We'll look into trade and tariff of the Trump administration. However, in order to remain compliant, we'll not be able to share securities advice with you during this call. It is important to note that this content is not to be seen as investment advice to you. We don't give investment recommendations to a broad audience. Our presenters state their own views, opinions, and strategies. My colleagues and I will be very happy to assist and answer your personal questions and recommend a strategy and investments that fit your personal situation. We want to make sure that our recommendations are meeting your expectations and are within your risk tolerance to help you to achieve your goals and ambitions. Besides this, we will assure compliance with both our regulations as well as your local rules. With this, let me hand over to Adrian Kirigin, our Chief Investment Officer in Dubai. Adrian, it's a pleasure to have you. The floor is yours.
Thank you, Mark. It's a pleasure to be here, and thank you, ladies and gentlemen, for joining us for another quarterly outlook. I will quickly share my screen. If you could confirm, Mark, when you see it. Mark, can you see it?
It's visible, Adrian.
Yes, perfect. Sorry.
Okay, great. Thank you. All right. So as usual, during this presentation on markets, the objective is for us to assess, where we stand in the global economy, in various individual economies, because as we'll see, we have for first time in a while diverging paths for some of the major economies because of specific policy decisions. And more importantly, we will aim to understand the implications on various asset classes. So first, I thought we should take a step back and rewind back to the beginning of the year. And what was the consensus back then? Why is that important? Because depending on the things that have happened since, it has significant implications for the extent of repositioning that is needed in specific asset classes. So this is back in January 2025. The left side of this slide shows you a survey that Goldman Sachs does at the beginning of every year. And the blue bar, the dark bar, shows the proportion of investors that expected US equities, the US markets, to outperform globally. And as you can see, these various bars show the proportion relative to previous years. Right? You can see that there were 58% of investors expecting US equities to outperform, and that was at least a 10-year high. So the consensus towards US exceptionalism was extremely strong. But most importantly, it was not only about the opinions of these investors, it was their positioning that was very much in line with this view. You can see, for example, on the right side, the amount of inflows that occurred just between November 6th and December 2nd. It continues towards year end. the flows were extremely strong towards US markets, whereas other international markets saw outflows. Now, where do we stand? At the end of the first quarter of 2025, you can see here the blue line showing the performance of global equities ex-USA, outside of the USA, and the performance of US equities at the bottom line. This spread is obviously extremely significant, and the question today that we're asking is whether it is justified and whether this divergence is likely to continue. So what has happened really? These very high and elevated expectations for the US economy to continue outperforming, because the basic assumptions were that Trump policies would be stimulative for the economy, and that they would actually be detrimental to the growth of other countries, mostly because of trade policies that were quite aggressive. And so what we've had is that, and this was the main concern we had at the beginning of this year, was that expectations were so high for the US to perform well that any minor disappointment could have significant impact on allocations. And we are seeing this materialize in front of our eyes. Now, the disappointments in terms of economic activity in the US have indeed materialized, but the question is whether they will actually lead to a significant slowdown or not, right? Because as we know, bear markets are very rare outside of recessions, right? So this is what we're tackling today. So first, what we're seeing is that what you're seeing on this graph at the top part is the sort of sentiment index by corporate managers in the manufacturing industry. And you're seeing two different lines. You're seeing a gray line that is showing expectations for price changes. And you're seeing a blue line that is showing the new orders that managers are expecting to receive for their various businesses. And what we see is that towards the end of last year, we actually had a recovery, right? The manufacturing industry was starting to see new orders. The election of Donald Trump sort of raised optimism. We saw that across businesses in the US. And this year, this has sort of reversed course. Yesterday, the data was actually published for the month of March, and these new orders actually fell further. So this blue line continued to fall, whereas the gray line continued to rise. And we're seeing something similar on the consumer side, which is the bottom part of this graph, showing again inflation expectations in gray accelerating significantly, and in blue the consumer confidence level falling sharply. Now, it is important to note that these again are surveys, although widely followed, and that's if you look at consumer sentiment readings and you distinguish between Republicans and Democrats, there's a very wide gap, with Republicans obviously being slightly more positive on the economy. But the point of this is that there's been a significant hit to confidence for businesses and consumers. And this is largely driven by trades, the uncertainty that continues to surround trade policy. We could have expected that by now people would know more or less where to stand, potentially being able to make business decisions on the new rules that were announced or that were supposed to be announced, but this has not yet been the case. So today is supposed to be liberation, right? You're supposed to receive the details about the US trade policy. Well, of course, it's possible that it will be less aggressive or less bad than expected, but it doesn't change the fact that the base case scenario remains that we'll have uncertainty around that for a while further. So this uncertainty has been a major hit to confidence for consumers and businesses. Now, the other component is looking at, obviously, the labor market is a key component of the US economy, because we've started to see some corporations saying that consumers are becoming a bit more cautious, but as long as they really retain their jobs, the amount of consumer weakness we can expect is limited. So when we look at the labor market, again, let's look at what businesses are saying and consumers are saying. So if you look at the sort of small business survey, it's important to know that small businesses employ about 50% of private market employees or the labor force, and therefore what they say has a very important lead on where unemployment goes. And you can see at the top part of this graph that basically their hiring plans, which are shown in gray, they are basically not going anywhere, right? It doesn't point to a significant acceleration in the unemployment rate. On the other hand, you look at consumers and you look at their expectations for deteriorating labor market, and it has risen significantly. So again, more uncertainty, more sort of concerns around surveys, which are basically called soft data, because they're not actual hard economic numbers coming out, but they have a tendency to lead the hard data. So today is the big question, because when you look at the hard data, retail sales, industrial productions, they have held up. They have done okay. But with this significant deterioration in confidence, and the longer it lasts, the higher the odds that it translates into actual weakness in growth. Right? Now, another element that we continuously come back to, because it has significant implications for the US economy, is what the housing market is doing. And when we look at the housing market, there's been, again, a number of weak data points in the last few weeks, despite the fact that mortgage rates have actually fallen, as you may know. And what we like to track, because it has often had a very important lead on the labor market, is what employment in the residential construction industry is doing. And that employment is this blue line that you see here. On the other side, if you look at building permits and homes under construction, they have been rolling over for a while and recently have shown further signs of weakness. Intuitively, if you have building permits that are falling, then homes under construction that are declining, you have home builders that end up cutting jobs. Right? And what we're seeing, there's a mismatch, but for the time being, there hasn't been a real rollover in that segment, and therefore not also pointing to a sharp deterioration in labor conditions for the time being. Now, one of the important elements to track when you look at forecasts of economic growth, it's the Atlanta Fed's GDP Now forecast. It's a high frequency estimate of GDP growth in the US. And this has sort of compounded fears when we started in February to have some weakness in some economic numbers, particularly on the survey side, as we said. You saw this metric that also takes into consideration these releases. You saw it dive. You can see this blue line here, basically, falling significantly sometime in Feb. And of course, there's this caveat to mention here is that if you adjust, one of the big negative contributors to this metric is basically gold imports, probably linked to the significant amount of delivery requests on the COMEX gold market. But if you extract or you adjust it for gold imports, you still have a negative reading that was at 0.5, minus 0.5 recently, and actually fell below 1%, minus 1% yesterday as it was updated. So again, the direction of all of these latest data points do increase significantly the odds of a slowdown. Something that, again, thinking back to the beginning of this presentation, nobody expected at the beginning of the year, and nobody was positioned for. Now, what are the real changes we've seen since the beginning of the year? If we remember the expectations around Trump policies, few people really believed that government spending would be cut. People expected the Trump administration to keep budget deficits elevated. Well, it seems like, and I would assume that this is largely driven by, obviously we know Elon Musk on the Doge side, the Doge effort, but also Scott Bessent, a brilliant and exceptional macro thinker that understands how the economy works, and obviously being head of the Treasury likely has a big significant impact on the administration's policies. Let's not forget, he was talking about his three arrows policy, a target to have 3% real GDP growth, 3% budget deficits, and 3% and 3 million barrel of sort of fossil fuel production, of additional fossil fuel production. So he seems to have convinced that the US, or convinced Trump that the US is on an unsustainable path, or was on an unsustainable path, and that cutting budget deficits is key. And I bring your attention to the quote here in this chart in bold. the market and the economy have just become hooked, addicted to this government spending, and there's going to be a detox period. We'll witness an adjustment as we transition from public outlays to private investments. Access to cheap goods is not the essence of the American dream. So Scott Bessent is basically telling us that for the time being, the objective is to cut government spending. But government spending, elevated deficits have been a big support for the US economy's high nominal growth. So this increases significantly. As long as this is maintained, you do have a slowdown on the cards in the US. This is an important change that the market has sort of had to grasp. The other component is, if we go back to now, let's sort of give a bit more credibility to what Trump has been saying. Trump has been elected on the promise to focus on Main Street, right? And you can see that actually his concern is very much valid. If you look at the proportion of the gross national income that accrues to corporation relative to worker, which is shown on these two graphs, the left side showing the proportion accrued to corporations, to corporate profits, and you see the proportion that accrues to workers through wages. This is not very surprising. What have we had over the last 25 years? Globalization. Corporations have moved their factories, offices to the place where it was cheapest to produce, and that meant higher profits and lower wages domestically in the US. And we know that Trump, he's been talking about wanting to do that, but maybe he is really intent on doing that. The problem is that a convergence of these two extremes imply weaker markets, right? As again, we bring the attention to Scott Bessent's saying, so Wall Street's done great, and that's obviously a euphemism, right? But we have a focus on small businesses and consumers. So we're going to rebalance the economy. We're going to bring manufacturing jobs home. And we're focusing on Main Street. Again, something important. As long as they continue to hold firm on this path, this is marginally negative for corporate profit margins, notably, right? Now, the narrative has really shifted. At the beginning of the year, everybody, or most banks, investment banks, etc., expected growth to remain firm and sort of elevated. And now, as you can see here, these are the sort of changes in GDP growth expected by Goldman Sachs in the coming quarters. And as you can see with this line moving lower, there's some expectations that growth will indeed decelerate. The question, therefore, becomes, have expectations been reset to a sufficiently appropriate level so that, and markets have corrected to a sufficiently appropriate level to potentially contemplate again being exposed, increasing exposure, because, again, these expectations can be exceeded. Let's not forget, the last 2 years saw huge gains in US equities. Why? Because expectations started the year very low and they were constantly revised throughout the year. We have a different setup, an opposite setup, and these revisions have begun. Now, what do we have elsewhere in the world? We've obviously started the year, as we saw in the initial survey, there was significant pessimism around the European economy, and we've had a number of interesting developments. One of the factors so first, in general, leading indicators have continued to point to marginally better growth. If you look at bank credit growth, a very important sort of driver of growth in the EU, because much more of the lending depends on commercial banks relative to the US, where there are capital markets, etc., that are much more active. And so when you look at credit growth, it continues to accelerate quite well, right? And loan demand remains quite high, which is the bottom part of the chart. So you continue to see this sort of underlying support. The other element is, of course, as we had sort of alluded to in our previous outlook, that the Germans have actually managed to reform their constitution, right? To sort of reform the debt brake. This is showing the German debt to GDP level. As you can see, it's at an appropriate, reasonably low level compared to other major economies, and have quite a lot of space to potentially expand budget deficits, right? They've announced 500 billion euros of infrastructure spending. They've announced, defense spending that will not enter into sort of borrowing restrictions, potentially 100, 150 billion. Even the sort of state governments will be able to run small deficits. So this is a structural shift for Germany, for potentially the Eurozone, as austerity will not become such a significant or an important objective for these economies. So you have a little bit of a contrast here, because you see that in the US, they are, for the time being, still bent on reducing government spending, and you have in Europe a door that's opening to significant fiscal spending. And so markets have sort of anticipated that. We don't need to look at this, but basically what are markets? If you look at surveys, expectations for economic growth are rising in Europe. Inflation also probably not in the next 2-3 months, but when the spending sort of kicks in later in Q2, towards end of Q2, it should also sort of support inflation, potentially increase inflationary pressures. So you have an environment potentially sort of with rising growth expectations in Europe. Now, what about China? So as we had pointed out also in the previous outlook, China has sort of made a turnaround in their commitment to support growth already back in last October. And it seems that it continues to go heavily in this direction. Recently, they announced the largest budget deficit target in the last 30 years. Interestingly, apparently, the accounting situation for the Chinese budget is quite complicated, and GAFCA does us a favor and actually sort of made the calculations. And it turns out that when you consider all these various intricacies, that the budget deficit in China is likely to be enormous this year. Now, whether it is 10, 5, 6%, of GDP, the point is that there as well, fiscal stimulus is set to rise as the government wants to stimulate consumption, the economy, support asset prices, and also, importantly, the property market. If you look at the property market data, it has shown signs of stabilization. It's still far from saying, there's a significant recovery there, but it feels like there is a floor under it. You see sales of residential buildings that have been improving, as you can see at the top part of this chart. So the month-over-month change in prices has sort of also moderately improved. The big reason why it is important is not because Xi Jinping wants to save the developers necessarily, but because he knows that stabilizing the property market is key to a rising consumer confidence, right? With, as we know, Chinese households having, depending on the estimates, 60 up to 70% of their net worth in the real estate market. Right? So this is an important factor. And again, this shows an important contrast between the US, Europe, and China, where the latter are sort of going in the direction of additional stimulus in the economy. Now, on the inflation side, we haven't seen much progress, right? So even though concerns on inflation have sort of been relegated to the second row because growth has been sort of the biggest change in terms of expectations, inflation has remained fairly sticky. If you look at the US at the top side of the charts, Europe in the middle, Japan at the bottom, the only place where there's still no inflation is China. So if you look at the US, you can see that it's still quite far from their target of 2%. In the euro area, also, it has sort of very difficulty, it seems to have difficulty to edge back at target or below it. And in Japan as well, there's still quite of an inflationary backdrop. And the key question here for inflation is, and we're seeing this across markets, you're seeing that services inflation recently has been coming down, but and likely to a great extent because of sort of shelter inflation sort of correcting. But there's been an offsetting factor. Goods inflation has sort of stabilized. And you can actually see this here. It's a little bit messy. What you can see is the bottom is basically, just look at the trend. The bottom are services inflation. You can see it's falling. And at the top, you're seeing energy, goods, and food prices. And you can see that there's been a recovery, right, in the last 6 months, right, which has partially offset this decline in services. So what is the key element to look going forward? First, you need to look at what tariffs are really going to be, because if you consider, that in the US, about 20% of CPI is goods, and 50% of goods are imported in the US, you could have, depending on the tariff level, an impact on that part of the inflation component. And at the same time, you also need to see what commodities are doing. And we'll get to that soon. So the picture is still likely to remain, with an inflationary backdrop, even though maybe the next reading is going to be a bit weak, but towards the end of Q2 is likely to continue to be quite sticky. So this creates a problem for central banks, and what have they been doing? So the left side is basically showing you the central bank rates, right? And they've continued to cut. As you can see, the Fed has been on hold, but the ECB has continued to cut. You can see the Swiss National Bank also cutting now down to 0.25%, lower than the Bank of Japan. That stands out as it continues to hike, but again, from very, very low levels. More importantly, looking at not what they've done, but what they're likely to do going forward, you can see on the right side the expectations priced into the market of central bank rate changes. And you can see that at the top part, you have the BOJ still expected to raise rates by 30 basis points by December 2025. And for the other central banks, the market is actually considering that the Swiss National Bank might cut another time, still undecided there. But at the bottom of the panel, you have the Fed expected to cut now over 3 times. Obviously, the latest weakness in data and markets have had an important impact on market pricing. So the ECB is likely to, our assumption is that if the growth does slow down as we expect, the Fed will indeed put in another couple of cuts. Right? We'll have to see what inflation does towards the end of Q2, but the Fed has cover in a way to cut, particularly when we look at what long-term yields have done, as I'll look at in a few minutes. On the other hand, the ECB, towards the second half of the year, with spending kicking in Germany, you might start to see, a bit of rising inflationary pressures, and therefore their cuts are not as guaranteed. Now, to close on the economy, on the economic side of the equation, and then we'll move to actually market action. You can see that the expectations have indeed sort of shifted a bit, but have they shifted enough? Right? You can see in the US, if you look at the top part, that we started the year, which is the middle bar, with 2.1% of GDP growth, expected for 2025. It has moved down to 1.9. It's noteworthy that the Fed has moved their expectations down to 1.7. In the EU, expectations have actually shifted lower, which is quite surprising. And then, between China and Japan, it's been mostly flat, and India marginally lower. But if we focus on the US and Europe, you still had, this is the evolution of these expectations, you still had at the beginning of the year an increase in growth expectations back in February. And it's only recently it started to correct down. So in our view, these expectations have not been reset enough given the underlying backdrop to be comfortable buying the dip in equities in the US aggressively. Now, so what does that imply for asset prices? So when we like to think, as many great investment houses do, such as Bridgewater, Millennium, etc. We like to think in terms of the 4 quadrants of growth and inflation. What is likely to be the combination of growth? Is growth accelerating or decelerating? Is inflation accelerating or decelerating? And as we've seen until now, you seem to have diverging paths for, let's say, the US and Europe, right? We're seeing for the US a note of stagflationary pressures, right? Which is the bottom left side of the bottom right side, apologies, of this graph. And for Europe, you're likely to see either an inflationary phase, or you're likely to see sort of a reflationary phase that sees in the first phase, inflation maybe moderate a bit, growth pick up. But either way, the implications are for equities to do better in Europe and worse in the US, right? In the US, bonds could do okay, even though a stagflationary backdrop is a bit tricky to manage. And in either cases, we're likely to see commodities do okay. Now, let's contrast this with what markets have been doing. So these are showing you the asset class performances in the first quarter. And you can see, first at the top of the panel, gold having an exceptional quarter of 19%, something that we'll get to shortly. Then the second best performer are commodities, 80%, despite oil prices being fairly weak in the quarter. This likely has also some implications or stems from some tariff uncertainties, with some materials being bought or purchases being front-loaded before tariffs. Still, commodities doing quite well. And then, as we saw earlier, you have global equities excluding USA doing up 6% recently, pulling back, and the US being at the bottom. Bonds doing okay. And again, bonds doing okay in the US, but in Europe, we saw in Germany one of the biggest jump in 30 years in their 10-year yields, showing that the bond market really believes that this is a structural shift, right? So again, you can't approach both bond markets in a similar way, just like you can't approach the equity markets in a similar way. So as mentioned, here you're seeing 10-year yields and 2-year yields for the US at the top and for Germany at the bottom. And you're seeing that there's been a significant fall in the 10-year yield in the US. You've seen a fall also in the 2-year yield as expectations of cuts have been increased. And you're seeing in Germany, you saw actually the short end fall because the ECB still expected to cut, but the 10-year retracing recently, but has increased, has gone up, and is likely over the remainder of this year to continue going up. This has obviously had implications for currencies as the yield differential has moved against the dollar. And the question, of course, now is, with the 10-year being under pressure, does it make sense to, increase duration significantly? And there are two sides of this equation in our view. Number one, yes, if the US ends up in a serious recession, the 10-year yield will continue to fall sharply. The other is that there is this year a significant refinancing needs for both governments and corporations. Just the US government is expected will have to refinance trillions of dollars this year, I think between 4 and 5. Corporations, globally, 17 trillion of debt will have to be refinanced by governments, and corporations at least 2 to 2.5 trillion. So these are very important supply increases that will have to be absorbed by the market. So when you think again about what Besant is trying to do, very likely, what was the backdrop we had in the last quarter? We had the Fed cutting rates, and we had the 10-year yield that went from 3.67 to 4.75, 4.8. This is the opposite of what you want to see when the Fed cuts rates, because the bond market was telling them too much spending, too much growth and inflationary pressures, and therefore this is going to be a problem. So Besant actually in February said that what the government is targeting is the 10-year yield. They want to see the 10-year yield lower, and they will do what they need to, even if that means pushing the economy or the slowdown in the first place. And therefore, in this, as long as this rhetoric is in place, yields in the US will, at best, be sideways and potentially have a little bit of downward pressure. But because of these sizable refinancing needs, at some point this year, whether it's at 4% or 3.8 on the 10-year, they will announce, they will extend the maturities of their debt, and this supply will have to be absorbed. So there seems to be, unless there's a very bad scenario on the growth side, which we still don't think is likely, there's a floor under these yields. So we still like, the 2 to right now maybe shorter duration on balances extend, up to 3 to 5 years. That's still, we were around 3 to 4, 3 to 5 is acceptable. Now on the currency side, we've had a significant reversal in the dollar, right? And again, this is extremely interesting because this quarter, this was another exceptional development in markets, because it's very rare for equities to correct in the US as they've done, and the dollar to fall at the same time. So this is another signal potentially by the market that there might be a shift, right? And before, everybody was wondering how the US administration is going to get their weaker dollar, because as we know, that was an important objective to reindustrialize the US, the Midwest, and bring manufacturing jobs back home. But it was very inconsistent with the expectations of growth continuing to accelerate, right? Or continuing to be very high. Well, now you have a government that's willing, in the first phase, to tolerate growth, to continue to exert pressure on the 10-year. And so we might see some bounces in the dollar, tariff-driven, whatever. But these bounces are unlikely to stick, and they are likely actually to be sold. And this is the way we look at the situation as well. Basically, you'd rather want to buy dips in the euro and the yen, than because these two currencies, especially the yen, extremely cheap and likely to see some significant revaluation pressures, right? Now back to equities. Here we saw already the divergence between global ex-US equities and US equities. Now let's look at more specific indices. So top, obviously, you have the Chinese A50, the large cap ETF from China, that's up nicely year to date. You have the Eurostoxx 600 up 11%, and then you have Japan barely positive. And then in the negative territory, you have all the US indices. What is noteworthy is that the equal weight ETF in the US, which was one of our favorite picks because of its more moderate concentration into the large cap tech stocks, has done relatively okay, being only down 1%. Now, when you look at the S&P market cap, you look at the NASDAQ down 8%, and more importantly, semiconductors down close to 13%. In dollar terms, that is obviously quite significant. Now, so what about the U.S. market? Right here, we're seeing the U.S. S&P 500 at the top of the charts, and we're seeing the 10-year yield at the bottom. As we already mentioned, the focus seems to be on bonds. And why? Because the dynamic that we had in Q4 of 2024 was very problematic, and Besson knew that most likely, and therefore they are trying to fix it. They are willing to push stocks lower and to save bonds, basically. And this is probably the reason why Trump, for the time being, everybody remembers his obsession with the stock market in his first term. Well, this time he had comments that were quite surprising, that the stock market is a fake economy, you can't really watch the stock market. This is a big change, and it tells people that for the time being, Trump doesn't really have their back, right? So this is an important thing, an important development. The technical picture for the US market has also weakened significantly. So now that doesn't mean, again, that if there's no recession, you cannot really expect, very unlikely, historically speaking, that the US equity market will fall, another 20%. But we still think that expectations, as we mentioned, have not come down enough, that you might have, at the margin, negative surprises, over the next quarter, and therefore that it will be very difficult as expectations are revised down for equities in the US to rally, close to recent highs. They might, in a sort of best case scenario, be range bound, and therefore you want to sell rallies, right? You want to sell rallies and you want to rebalance. And the problem is that global investors are so long US equities that it's a bit hard to understand, the magnitude of these rallies. Now, a lot of sentiment readings are very pessimistic right now. You can see that it has shifted from extremely bullish at the beginning of the year to quite bearish now. This points to potential relief rallies in the second quarter, and they should be taken as an opportunity to lighten up. Now, another thing that is important to note, and we've seen global investors, fund managers, the more nimbler investors rotate out of the US in the last month or so. But if you look at US private clients, clients of Bank of America, or I believe those of Goldman Sachs, they've been buying the dip. They've been buying the dip, right, in March. This is obviously a mechanical response that has worked very well over the past many years. Buying the dip is the only way to succeed, right? And so this doesn't speak of capitulation. It speaks that there's this reflex that will, in our opinion, likely be sort of proven wrong in the coming months. Now, looking at earnings expectations, another important component. Let's focus on the left side with the US. At the beginning of the year, earnings expectations were at almost 15% for the US, right? And as of at the end of March, these expectations had moved down to 14%. call it 13.5%, 14%. It's still too high. This is, again, and we'll see, the earnings season is starting. We'll see what corporations are saying. But if you are a corporate manager right now, and you see the uncertainty that you have around tariffs, that you have around the economy, government spending cuts, etc., it's your golden opportunity to revise your guidance down and then potentially exceed it later on. So this is another element. We think that these expectations are still too high. They're likely to move lower. And that, again, sort of caps a little bit the upside in the US because valuations are still quite high. Right? Then another thing to note briefly is that in India, that we'll get to shortly, you've had a significant downward revision, right, from 18 to 13. Still quite, sizable growth. We'll get to whether this, makes it interesting or not. In Europe, though, you have only 5% of EPS growth expectations. Seems to be okay, could be slightly revised up, but seems to be okay. Valuations are attractive and therefore much more interesting. Let's look briefly at sectorial performance in the US. As I alluded to earlier, oil prices have been quite weak, right, for a combination of factors. And yet, the best performing sector this year in the US, in the first quarter, have been oil stocks. Likely driven by, expectations of maybe deregulation, but also, also the fact that we are still in an inflationary backdrop, and maybe that is an attractive hedge to keep in portfolios. And you see at the bottom that the Magnificent Seven stocks have really been the poorest performers this year. And this is important because yes, some of them now have corrected sizably. They're very prone to a rebound. Some of them are fairly attractive. Maybe Amazon, for example. But the problem is that if we do have a continuation of this rotation out of the US, given their size in benchmarks, they are going to receive the most selling pressure, right? We think that the odds that technology sector regains leadership in the US are quite low. So you would want to potentially focus as there might be some short-term disappointments in growth, potentially looking at some financials, maybe a little bit of industrials, but looking at sort of not trying to buy or remain over allocated to these technology names. So as I mentioned, there's been a rotation already out of the US. You can see here, this is the March fund manager survey by Bank of America. And you can see that the change in allocation, which is shown on this bar chart, from the US to Eurozone has been quite sizable. So maybe is it already over? Have all the investors that needed to make this shift, have they done it? And the odds are quite low. If you think about the current weight of US markets in global indices, which is the right side of this chart, we're still around 70%. Right? And in Europe, we're down to what, 16 to 18? Because we've had, over all these years, a situation where the US is always the place to be. Now, it seems like there are alternatives, right? Whether this is the beginning of a structural shift that will last years is a bit too early to tell. But the odds have never been higher that this rotation could continue, given the respective policies of these governments. If you have that, it doesn't mean that the US weight has to go back to, or has to go down to their proportion of global GDP, which is 26%. It will never happen. It will go maybe back to 50, 55, 60, but even that is an important shift. And on the other hand, you have most economies that are trying to put in place policies to attract capital or to convince capitals to stay home. Typically, we've had recently the European Commission talking about the savings and investment union, right? Potentially talking about pushing domestic investors to institutional investors to keep a bigger portion of their allocation domestically, putting in place investment vehicles for citizens to sort of invest in their own companies. So all of this is sort of speaking in favor that yes, short term we might have EU a bit under pressure, the tariff announcements, etc., and US sort of picking up. But in our view, we're in an environment where you want to buy the dip in Europe and you want to actually sell rallies in the US. In Europe, just briefly, because of the structural reflationary environment, you actually want to potentially buy dips in banks. As we saw, the credit cycle remains quite solid. So if you do have an 8 to 10% pullback in banks, you want to potentially get exposure there. In industrials as well, there's a big, as we mentioned earlier, infrastructure package that will benefit industrial companies. So you might want to look at weakness, in the coming weeks to add to these sectors. Japan is a little bit of a tricky situation. We've had the same view for the last couple of quarters. It's been if you look at indices, of course, within indices, there are always opportunities, and that is the job of our fund manager in Japan to select those companies. But indices have gone nowhere. You can see that the Japanese market is basically flat over the last year or so. The yen has appreciated, not enough in our view, but it has appreciated. And so you have a situation where, and you can't exclude, if this sort of consolidation breaks down, short-term weakness in Japan, but it has a number of factors still going for it, right? Buybacks are rising, shareholder-friendly policies are continue to improve. Corporate activism from international investors continues to rise. So it's really the question of, if you do have this increase in the yen's value, it could temporarily, exert pressure on this market. Something to keep an eye on is whether institutional investors repatriate part of their large savings back into the Japanese market and in Japanese assets. You can see the 10-year yield in the middle of this chart rising significantly up to 1.5%. It's likely to continue rising. So the allure of Japanese investments for residents is definitely rising. For the time being, it's kind of a neutral view. Cannot exclude some short-term weakness. China, as per what we said, is we retain the same view. China is viable on dips. The government is still very supportive. Allocations, interestingly, Goldman Sachs was pointing out that as of the end of February, global fund managers had an allocation that is in this 12th percentile. It's still very low. So, it's mostly been rising because of outperformance. Still think that, weakness driven by tariffs, etc., are viable there. The Chinese tech side is obviously also still quite attractive. Something I didn't mention, but obviously has been a key element in the underperformance of US tech as well, is the realization that their ability to spend dozens of billions of dollars of capex will not guarantee their hegemony in the AI space, right? You saw these DeepSeek developments that are likely to lead to significantly lower margins, and also the realization that all this capex, part of it, was potentially not appropriate, let's say, as we saw recently, Microsoft trying to back out of data center deals, and some CEOs of US tech talking about the fact that China is flooding the market now with cheap large language models. This is a structural shift, and this is why probably you don't want to buy certain, I won't cite the name, but certain large cap semiconductor stocks on dips either. Finally, India. India has gone, we've always looked briefly at India. India has gone through a sizable pullback, close to 20% from top to the recent low, back to a level of valuation, as you can see on the right, that is sort of under the 5-year average. Of course, it's still a pricey market. Why? Because there's a structural runway for growth that few economies have, or probably none in this magnitude. And we think that now we want to watch, sort of watching it to see whether there's another pullback that makes a higher low. I think that in this area, as for those that don't have any, probably makes sense to start allocating. For those that haven't been, to jump on this long-term trend. Right? Gold, the top performer of this quarter, making new highs every other day. Now you remember that the core reason why gold was rising so fast is because the misguided decision to freeze Russian reserves back in 2022 has led to a significant surge in buying by global central banks. Misguided not from an ethical or moral standpoint. That's not what we're concerned about here. It's about just from the implication it might have on the dollar's role internationally. We've seen less treasury purchases. We've seen a lot of gold buying. But Western investors, retail investors, were not participating until recently. You can see the middle of this chart. These are basically tracking the amount of gold held by major ETFs. So typically this goes up when there's a lot of buying, right? And you can see that in this latest significant run-up of over 50% since the mid of 2023, there's been outflows, right? And it's only recently, you can see this starting to pick up, where you have retail investors seeing 2 stellar years in gold, and this year, obviously, in the amazing quarter, capitulating and jumping on the bandwagon. This is, for us, a sign that it's probably time to take a bit of profit, right? You want to potentially cut this allocation, start to trim 20, 30% of it. There's no telling how far this goes, because if these inflows continue, there's no telling how far it goes. So you don't want to, stop an exposure to such a good trend. But when sort of people that have missed it jump in, it's probably time to take some profit off the table. Finally, commodities, very important to keep an eye on that because it will have significant implications for inflation. As we said, oil, basically we know that one of the objectives of the Trump administration is to put to sort of weaken energy prices to offset inflationary pressures. They might be able to do it. For the time being, oil has held this sort of multi-year support. Basically, if it does break it, trade under it for a couple of weeks, you probably just want to get rid of your oil exposure. But for the time being, it still makes sense to hold it. Commodities have done okay this quarter, and in an inflationary backdrop, it's still an asset class that makes sense in portfolio. So this is the view. Now, to close, thank you very much for your attention, and don't hesitate if you have any questions, whether here or just sending me an email. The conclusion is that we are seeing diverging sort of market regimes for the large economies, and that you want to assume that this rotation out of the US probably has legs that might continue for the foreseeable future. That therefore, as long as the US administration keeps this current policy mix in place in the next quarters, call it 3-4 quarters, you probably want to be a seller of rallies in US equities. Of course, it's a very fluid environment. We'll have to see what they do. But for the time being, the environment favors selling rallies in the US, buying dips in European and Chinese markets, and potentially Japanese as well, slightly bigger dip. Thank you very much again for your attention, and at your disposal.
Thank you so much, Adrian. That was, as ever, very insightful. Thanks for sharing. We see the time flies when we're having fun. So let's go straight over. Today was proclaimed as the Freedom Day by the Trump administration. So I think there is no other perfect time than to bring Martin Naville, the former CEO of Swiss American Chamber of Commerce, to our webinar now. The Swiss AmCham is the leading business association with almost 2,000 members. It's facilitating a business between Switzerland and the US, and Martin has led the Swiss AmCham for 2 decades. Before that, Martin spent 16 years with Boston Consulting Group in Munich, Zurich, and New York. In 1995, he was elected partner and director of Boston Consulting Group at At BCG, he specialized in the field of wealth management and telecommunications. Martin started his professional career in 1984 as a corporate banker with JP Morgan in Zurich and New York. In January 2025, Martin joined the Trusted Board Advisors as a partner. TBA is a leading reputation management advisory firm in Switzerland. Amongst other positions, he is a senior advisor of Morgan Stanley Switzerland, as well as the Boston Consulting Group. He is a member of the Global Advisory Board at ETH Zurich and a member of the Foundation Board of IMD in Lausanne, 2 of the globally leading schools here in Switzerland. To round up an amazing profile, Martin has served as the chairman of the board of the Zurich Zoo for over 2 decades. Martin, welcome to the Probus Pleion Quarterly Outlook. It's a true privilege to have you here.
Thank you, Mark.
Martin, we're living in amazing times. You are so closely involved, and you've been, so closely entrenched with both economy and politics between Switzerland and the US. When you look at the US today, what is your take on this Trump 2.0?
So, Mark, thank you very much for the kind introduction. I'm not quite sure my video works.
It does. Perfect.
It does. Okay, because I only see you. Great. So, first of all, it is really a bad time to talk now. We are, about 8 hours away from Liberation Day, and we have no clue, what happens. So, I'll try to make it a very black and white picture, and I hope I will be proven right by the same time tomorrow and not totally wrong and total idiot on this. And let me just preface this by saying I'm absolutely not a fan of Donald Trump. I've been slightly disparaging on TV also many times about this. So it's not the person Trump, but I don't think he does everything wrong. Let me preface also that he's been democratically elected. For U.S. relationships very, very, very clearly, and one of the few politicians who does now what he says. And I think that's very important when we, breathlessly are indignated by, what is this idiot doing? We have always to say, A, he holds his promise. He has been elected. He holds his promise. And second, he doesn't do anything really different from other presidents. Directionally, he's in the same direction for the last 30 years. Presidents have said Europe has to pay more for the defense. Presidents have said it's unacceptable that Europe has 50% higher tariffs than the US, and China has 250% higher tariffs. It's unacceptable that the US pays way over proportionally for the supranational organization. Example, WHO. The GDP of the US is 24% of the world. They pay 43% of the budget of WTO, WHO, and all those organizations. So directionally, he does exactly the same thing. If we want to understand what he does, I recommend to everybody to read The Art of the Deal. Little booklet, 1987. Donald Trump has written, or at least had it written, we're not quite sure. And he describes how to do a deal in there. And the deal has 3 steps for him. It's insult, destabilize, and then slam them with the maximum demand. And then at the end, look what's coming out. And I think we have all those sayings that he has been doing, all those pronouncements, we have to put into this 3-step logic. It's first insult and destabilize. And we're still very much in this phase. You remember that he's been in the White House for less than 10 weeks now. We're still not in the slam with the maximum demand, and then let's see what comes out. And so very much we should, take back the breathless indignation and look at the facts. I don't know if you want to ask a question or if I should just go on.
No, I mean, I really appreciate what you're saying. And, delivering to promise is for the Western world something that's almost strange for a politician. And maybe he is not that much of a politician, and that's why he does. But, you say, okay, so far, there's been little surprise, or are there surprises that you have seen in the first 10 weeks?
I think there are very little surprise. I mean, the only surprise for me has been the sequence that he has put the tax reform a little behind the tariffs. But that explains it very well. Is that tax reform is legislative, is on Congress, and Congress just takes more time. Because I think what's really important is we have to understand that, all those talk about dictatorship and about him having a third, this is all provocation. America has the strongest separation of power of probably all the countries, maybe even including Switzerland. We have, legislative, judicative, and executive like other countries. Then we have a very aggressive media. And then, and only the Swiss understand this, is the horizontal separation of power. That means the power of the individual states, like in Switzerland, the cantons. There is no other country that has such a divulged power in the lower elements of the society. And that makes it a very, very strong backstop against anything. Now, why does he do what he does? So first, we heard about the 3-step of his negotiation tactics, but second, he has very, very little time, and nobody writes about this. He has another 12 months to change what he wants to change. In 12 months, we will get the primaries for the midterm in November 2026. In the midterms, we will have first Senate, currently 53 to 47. That means in the midterms, the Republicans can lose 3 seats, and they still have a majority because of the key vote of the vice president. If they lose 4, they lose the Senate. They will have to protect 23 seats versus the 11 that the Democrats will have to protect in 2026. And in the House, it looks much worse. Even after yesterday's 2 temporary elections in Florida, they only have 7 out of 435 seats in the House, 7 additional. That means they can lose 3. If they lose 4, they lose the majority in the House. And in the midterm, especially the House, the reigning party always loses. Depends a bit how much. So clearly he's in trouble. He's in trouble time-wise, and this is why he goes really, really fast and goes much faster than executive or legislative. And this is why we have this imbalance currently that creates a lot of uncertainty. But clearly, the technical saying is flood the area with shit as fast as possible. And this is really absolutely what he does, because he has in 12 months, 3 benchmarks have to be acceptable to the public. It's illegal immigration, and that has been has gone pretty well until now in those last 10 weeks. Second, it's inflation. The Democrats have lost the election primarily because of inflation. Inflation, as we've seen, there is some uncertainty, but it's still relatively controlled, and it has to be right in 12 months, not today. And then stock market and interest rates have to be right in 12 months, and then he has a chance to keep the House. If he loses the House, then the Democrats take over all the chairmanships of every committee and subcommittee. And in other words, he will really be a lame duck by then. So he's doing everything to be in place on Easter 2026 to win the midterms.
Thank you so much, Martin, for that. So can I check, when you're looking at immigration in combination with also inflation, right? When you're pushing people out of the US that are currently in the workforce, at the same time you want to bring back jobs, and you have you don't have a huge unemployment at the moment. Am I not correct to fear that inflation will be clearly one of the things that he may simply just miss?
Okay, so first of all, he's not pushing out tons of people. He talks about this. This is all blubber. In his first 4 years, he has expelled less people than any similar period under Obama or under Biden. I mean, Obama was the expulsor-in-chief. So we don't see numbers. We see a lot of media. I mean, CNN is always looking for, the few things that happen. But in numbers, those first 10 weeks, he has not expelled any kind of record numbers. So in terms of participation in the labor force, that has not made a dent. Second, America is the most domestic economy in the world. So import and export is, percent of GDP is lower than every other country. That means even if it brings back tariffs, the tariffs will hit the shelf late and relatively mildly. Every economist has another number, but clearly it's going to hit much less than all the other partners. And until you get the effect, then probably he isn't under control again. The only interesting thing is fruits and vegetables from Mexico, which is about, I don't remember the number, 65% of the fruit and vegetable that goes into a very low margin economy, the supermarkets. That could hit inflation, and the wood from Canada. So we'll see what happens with Liberation Day today, especially look at the fruit and vegetable from Mexico and the wood from Canada. And then, as we said, he doesn't have to be right now. If inflation goes up a bit this summer, but he has it back under control in Easter 2026, he's fine. And so, we heard Bessent, what he wants to do, and he has to do it now because, he couldn't do it later. And everything that Trump wants to do, he does now in the next 3 months to be able then to correct with those 3 rail guards, immigration, inflation, and the stock market, to be able to correct it until Easter 2026.
Okay, I appreciate. Now, when you're in touch with CEOs of whatever size companies, be that in Switzerland or in the States, what do you tell them in terms of how do we deal with the uncertainty in terms of tariffs? What should we do as CEOs, as or what should we do as investors?
Well, that's a tough one. Everything I say now could be totally wrong tomorrow morning. I mean, that's this part of the, insult, destabilize of the Trump thing is keeping everybody on their toes. I think, if we go away from breathless indignation to facts, I mean, fact is, Tina, there is no alternative to the US. We heard it's 70% of the world's security. It's 65 of the top 100 companies by value are in America. You have 90% of all FX trades go into or out of the dollar. It's the largest oil, the largest gas producer. It's a net exporter of energy. 7 of the top 10 universities are in America. It's key to our security. So there's no alternative, especially for Switzerland. It's the largest export market, the largest foreign direct investment market in both directions. It's the biggest partner for our education and research environment. So there is no alternative. And I think that's the first thing that everybody has to understand is not those 10 weeks are totally changing the world. The second thing is very clearly, I mean, it's not just now with Trump, I mean, it's been before, the geostrategic upheavals means you have to be a lot more agile. So if you have done globalization and optimization and put all your manufacturing to China, now you're in trouble because you didn't pay for the insurance, for disruption of the value chain, disruption of the supply chains, for the geopolitical uncertainties, etc. So those companies who have not paid the insurance by doing those plan Bs and plan Cs, they have to do it now and very quickly because nobody really knows what's going to happen. I mean, we know now China is having this huge exercise around Taiwan. If something happens, then what the Americans say, shit is really starting to fly. And you have to be prepared as a company. So away from the pure optimization without insurance to an insurance, I mean, an operative insurance. I don't mean a financial insurance, an operative insurance. You have to have a plan B, a plan C. So even China +1 for many manufacturers is probably not enough. You have to have a China +2, +3, other countries where you manufacture. You have to have all the sites. You have to have flexibility where you can move things around the world in more or less real time. So I don't think there is a need to completely change the strategy, but there is a need to increase the agility and the flexibility massively.
Very good. And I see time as I said before, flies when we're having fun. Martin, any concluding sort of wrap up? What is your view? How will Trump 2.0 really drive us through the next 2.5, 3 years? What are you seeing?
One thing is very important. He has said it before: free, fair, and reciprocal. If you have something that is not reciprocal, like tariffs on cars or the participation and defense budget, etc., if it's not reciprocal, you have to change it because you will be obliged to change it. So you rather do it in your own terms than under pressure from the US. And the second is, magicians have this trick: is they wave with the hand and with the other hand they do something. Don't look at the waving hand. The waving hand is, yes, I'm thinking about a third term. Yes, I'm going to slam 200% tariffs on something. Look what he does with the right hand. That means look at the facts. And that takes away also this breathless indignation that we see in all the media today. I mean, not just today. I mean, for the last 10 weeks, where they have discovered this what all the things that could happen. And let's look at facts and let's look at what really happens. I mean, let's look at the right hand of the magician and not on the left hand that does the waving. So I would say, and then just take out the indignation and be a little more down to earth.
Fantastic. Martin, that's been amazing. Very greatly appreciated. Thanks for sharing your insights. We could listen to you for another half an hour, I'm sure. But I have audience that has other things to run to. But we'll come back to you, Martin. We'll speak more longer. It's been fascinating. So thank you very much, Martin. Dear audience, if you have questions beyond the ones that I've already sort of tried to bring in now with Martin, please let me know now. If we don't see, then we'll sort of go towards the end. No, I don't have anything now. So before we start, can I ask you to take note of our next webinar? we're going to host our next Probus Pleion Spotlight on Europe, the end of austerity, implications and opportunities. That will be held on Thursday, 22nd of May, 10:30 a.m. Switzerland, 4:30 Hong Kong and Singapore. And then let me thank Martin and Adrian for their insights today. It's been greatly appreciated. Of course, such calls are only possible with significant help from colleagues who work behind, who make it happen. So thank you all for today's webinar and for making it possible. Then, dear guests, on behalf of all of us here at Probus Pleion Group, let me sincerely thank you for dialing in. We're deeply grateful for those of you who are already our partners, and we thank you for your business and your trust. For those of you who are contemplating joining us, we appreciate your consideration and the time that you give us so you can learn and discover our advantages in the service offering. Thank you all again for being with us today. We're looking forward to our next opportunity to see you in person. Goodbye and thank you. Cheers.